BitMine and Strategy sit on a combined 16.5 B in crypto treasury losses. Two of the largest corporate crypto holders are deep in the red on their bets. BitMine is down $8.9 billion on its Ether holdings, while Strategy is down $7.6 billion on its Bitcoin position, according to a June 3, 2026 update from Cointelegraph. Together, that is about $16.5 billion in unrealized losses across the two best-known crypto treasury companies. The figures are paper losses, not booked sales. Both firms still hold their coins, but the scale of the drawdown puts a hard number on what the recent sell-off has done to the treasury company model that defined much of the last 2 years. A combined hold the size of a mid-cap company, BitMine, built its balance sheet around Ether, and Strategy is the original Bitcoin treasury, holding the largest corporate BTC stack on record. Both rode the strategy of raising capital and converting it into crypto, betting that long-term price appreciation would outrun the cost of the capital they raised. That bet is underwater right now. An $8.9 billion mark-to-market loss on ETH and a $7.6 billion mark-to-market loss on BTC are the kind of numbers that, on their own, would rank among the larger corporate write-downs in any sector. Here they sit inside two firms whose entire reason for existing is to hold those assets. The losses track the market. As of June 3, 2026, Bitcoin trades near 66,970, down 3.9% on the day and 11.6% over the past week. Ether sits around 118.78, off 4.9% in 24 hours and 9.8% on the week. The Fear and Greed Index reads 26, firmly in fear. A treasury company is, by design, a leveraged expression of those two charts, so a double-digit weekly drop in the underlying shows up directly on the balance sheet. Unrealized does not mean harmless. A paper loss only becomes a realized loss if the firm sells. Neither BitMine nor Strategy has signaled forced selling here, and both have historically framed their holdings as long-duration positions they intend to keep through drawdowns. On that reading, $16.5 billion in red ink is a number on a screen that reverses if prices recover. The catch is the capital structure underneath. Treasury firms typically fund purchases with a mix of equity raises and debt or convertible instruments. When the assets fall, the equity cushion thins. The premium that lets a firm raise new money above its net asset value can compress or flip to a discount, and the cost of servicing any leverage stays fixed while the asset backing it shrinks. None of that requires a sale to cause pain. It shows up as a weaker ability to raise the next round on favorable terms. That dynamic is not hypothetical. Strategy disclosed its first crypto sale just days ago, parting with 32 Bitcoin, a small but symbolically loud move for a company that had only ever bought. Strive, by contrast, used the same weakness to add 2,500 BTC. The Treasury cohort is splitting into firms that buy the dip and firms that trim, and the $16.5 billion loss figure is the backdrop for both choices. The counterparty lesson for everyday holders. For people who actually spend crypto rather than warehouse it, the takeaway is less about these two tickers and more about where balances sit. A treasury company carrying billions in unrealized losses is a reminder that any entity holding crypto on your behalf has its own balance sheet, and that balance sheet can come under stress in a downturn. That is the case for keeping spending funds in your own custody rather than parked with a third party whose solvency you cannot audit. Cards that let you spend from your own wallet keep your balance outside any single company's books, so a provider's drawdown does not freeze your money. The flip side is that holding volatile assets to spend means your own purchasing power moves with the same charts hitting BitMine and Strategy, which is why many users route day-to-day spending through stablecoin-funded cards and keep BTC or ETH as a longer-term hold. None of this is investment advice. It is a structural point. The same price move that opens a $16.5 billion gap on two corporate balance sheets also moves the value of whatever you are holding to spend.